Hello all. So Shopify is a company that I really like. I'm generally speaking a fan of e-commerce and I have done it myself. It's a very interesting platform. Now the thing is, when we're looking at a very interesting platform and generally speaking a very interesting industry, we want to be making sure that if we were to buy this stock, we're actually getting a good value. We don't want to be buying overpriced assets just because we may end up losing a lot of money into the future. And this has already happened with Shopify. Think of these people who actually bought here at $1,700. And this is what happens a lot with stocks. People are hearing that e-commerce is the new thing and it's amazing and all, which it is. And then they hear of Shopify and dropshippers and they are thinking, okay, I should be buying. And they keep on buying and buying, and they see the price going up and they keep buying. And so at some point, the company reaches $1,700, and then it comes down to 800, and still has a forward PE of 143. So imagine what the PE was over here. So we're looking at a company that looks massively overvalued based on the financials. And the very interesting thing to notice here is that the last 12-month PE is 32. The next 12-month PE is 143. That's the projected one. And generally speaking, forecasts tend to be positive, tend to be a little bit too positive at times. And in this situation, I mean, that doesn't really spring any confidence here, does it? I mean, this looks like it's getting worse and worse here. In this video, I wanted to examine the company from a standpoint of an investor who wants to discover what is a good price to pay for Shopify. And you can do all sorts of models and go very deep. And it is in my plan to actually do that in the future. I'm actually even working on a software tool that will be doing that for all of you. And I will be letting you know as I finish the deployment of this. It will take a few months still. But I wanted to use a very simple mechanism, a simple way to show you how to quickly calculate a good potential price to pay for any stock really. And we're gonna do it with Shopify as an example here. Before we proceed, let me thank you for watching this, and if you do like this content, please like it. A like helps a lot, it really helps the channel, so thank you. And if you do like this kind of content, please subscribe, and you can also join us on Discord. We have a channel and you can find the link in the description box below. Okay, that said, let's take a look at the company's free cash flow, and we're going to use the free cash flow to actually evaluate how much we're willing to pay for this company. Now, why are we using free cash flow? So free cash flow is basically the amount of the company is making with their operating income. So it's this line. If you go to the free cash flow statement, you will see the cash from operations here. So it's basically getting this cash from operations amount, and it removes the capital expenditures, it subtracts the capital expenditures. So for instance, 489 million here minus 31 is going to give us a free cash flow of 458 over here. This is how it's calculated. It's operating income, operating cash flow minus capital expenditures. And you will see here in the free cash flow that in 2017 and 18, Shopify was actually losing money, which is fine. It's a growth company and it's growing nicely. We can actually very quickly examine the growth as well. You can see the growth here in terms of the revenue and the gross profit, and you can kind of see the net income also over here. So the company is definitely growing. That's a very good sign. Now, we're looking at the free cash flow over here, and I am willing to actually exclude these years because it looks like the company has been growing massively in the past couple of years, I guess, although this is not massive growth over here. But still, I'm willing to exclude those because they're almost zero and they will really skew our results here. So I'm just going to get these last couple of years here, and that's already inflating my valuation a little bit, but that's fine. So 383 million for 2020, and the last 12 months $458 million. So which means this is between these 2 years, the average free cash flow is about 400 million, let's just say, is what the company made in free cash flow. Now, when we are calculating whether we're actually willing to buy a business, how do we think about it? We're like, okay, this business is making $10 a year, and I'm willing to pay, let's say $50 in order to buy this business, which is the 5-year cash flow that the company is making. But would I be willing to pay $200? Not really, because these $200 would come back to me in 20 years. So unless the company had some insane growth, I would be taking a lot of time to actually get my money back. And when we're investing, we want to be buying this cash flow at an as low valuation as possible, at as low price as possible. And so in this situation, let's just say that we're willing to pay a multiple of 30, which is already very, very lucrative. Just because it's a tech company, and with tech companies you are okay to pay a little bit of a higher multiple, just because they are growing nicely. They tend to grow nicely, they have nice margins. So typically an investor is willing to pay a higher multiple of earnings or free cash flow to buy this company. So meaning that I'm willing to spend more money up front in order to potentially harvest the growth over the years. That's what a higher multiple means. And typically you are looking at a 20 to 30 multiple for companies. And if we're talking about large companies that do not grow that much, you may even be looking for less than 20 or 15. So in this situation, we're looking at a company that has $400 million a year in terms of its free cash flow. And so I'm going to use my calculator here, and I'm going to go 0.4, which is $0.4 billion a year is what the company makes for 100 million. And I'm going to multiply it by 30 over here. And so this gives me 12. What is that 12? This is $12 billion. Remember, we multiplied 0.4 billion with 30, which is a multiple. So we're looking at a $12 billion valuation for the $30x multiple that we used here. So we're expecting the company to cost about 12 billion today if we give it a multiple of 30 times free cash flow. But the current market cap of the company is at $110 billion. And if we do 110 divided by 12, we will see that this is 9 times more than what we calculated for a multiple for a 30 times multiple of the free cash flow. We are still looking at a 9 times higher, almost 9 times higher of a market cap. And when we're looking at a 9 times higher market cap, what does that mean? It's the price of the stock multiplied by the amount of outstanding shares. So the amount of outstanding shares is the same in every situation, as we're looking at it today, I mean, not in the future, because that may change. And so what we can do is we can take the price of the stock, the current price, 876, and divide it by 9. So 876 and divided by 9. And we get 97, about 100. So $97 and $7.3. So basically what we calculated here is that if we give this multiple, this company, a multiple of 30 times its free cash flow, we are willing to pay $97 today to buy this stock. But the thing is, the stock price is $876. This is 9 times more than what we are willing to pay if, again, we give it a multiple of 30. So as you can understand, the current multiple of its free cash flow is more than 100, really, and it's massive. It's absolutely massive. This means that you would be waiting for many years in order to get your money back, at least if you're concerned about free cash flow. And this is exactly what happens with these hyped up companies. People keep buying. They don't really care about what's happening in the economics of the company, and they just keep buying just because it's a household name, everybody knows about it, it's all about the trend and e-commerce and dropshipping. But as an investor, you have to be a little bit smarter than this. You have to be thinking, am I getting my money's worth? What is my return on investment here? And so this is why we're using these kinds of multiples and calculations to establish whether it's actually worth it to enter a company right now. And so you may be thinking and you may be asking yourself, okay, if not now, when would I enter this company? I mean, it's probably going higher, right? And the answer to that is maybe never. There are many other opportunities. I mean, why actually take the risk of a company that's potentially going to decline massively in the future? The slightest thing going wrong can really decline this one, just because they are not making the cash flow to sustain the current growth that they have and the current price actually of their stock that they have. And so this is what I wanted to to help you understand in this video, in case you are not aware of this kind of modeling technique. And this is a very, very simple concept, and we can go much, much further than this and examine free cash flow growth and all these things and create a DSCF model, for example, which we're going to be doing in the future as well. But for now, I wanted to give you a very, very quick idea and a very, very quick methodology to actually discover what is a fair stock price to give to pay for a company. And you can start from this 97 value that we found and be like, okay, maybe not 97, maybe I'm willing to pay 120, 110, maybe my higher threshold, my highest threshold. But is it 876? That's extremely far away from 97. So this is why we're using this kind of baseline calculation to see how far we are from an actual positive valuation from our side, from a positive purchase from our side. So I hope that helps you a little bit and kind of gives you an idea of what kind of tools and techniques you can use to value the actual price of a stock and a company. And again, you have to value it based on what the company is doing financially, because you don't have anything else. Everything else is speculation. So thank you for watching. I hope you enjoyed. Again, I'd love to see you on Discord. And if you did like this video, take a look at this one that I made earlier, and it's about Alibaba and a deep down discussion about its earnings. Thanks for watching this. I'll see you soon, guys. Bye bye.